Hi, welcome back to my webinar on 7 Habits of Highly Effective San Francisco Buyers. My name is Hanna Jung. I'm a realtor at San Francisco Modern Real Estate. Today we're going to go over the seventh habit, Tenants-In-Common. Before we begin, let me give you a disclaimer that I'm not an attorney, so I cannot give you any legal advice. If you have any specific legal questions or need any legal information, please consult with your real estate attorney. So TIC is my favorite topic because it is so unique to San Francisco. And tr truthfully, a lot of times buyers do not necessarily understand the pros and cons that comes with Tenants-In-Common. They have a big fear on TICs, but they don't necessarily know where that comes from. So today I'd like to go over what it really means and what you should look at when you decide whether or not TIC is the right fit for you. So what is TIC? Tenancy-in-Common. TIC is a type of shared ownership, a co-ownership of a property where each owner owns a share of the property, a percentage of the one building. So what does that mean versus condo? When you own a condo, you're actually owning a legally divided physical unit. So in the deed, it shows in a map what you own. However, when you own a TIC, the deed will show only your ownership percentage. That's the biggest difference between the TIC and versus condo. And even though it's a co-ownership, it doesn't come with the right of survivalship. So when an owner is deceased, then his or her interest will go to his or her heir, not the rest of the owners. You're owning a property with a stranger, so obviously you don't want to give your interest to the strangers. So that's protected. So that is what the TIC is. Then what are the disadvantages? The biggest one, the biggest bad reputation that TIC now has comes from what's called group loan. So group loan is that all the owners, let's say if it's a 4-unit building, all 4 owners are sharing one group loan and are responsible to each other. So let's say one person defaults on the loan, then 3 other owners are responsible for that person's financial duties. However, it's no longer the case because a few local banks are now offering what's called fractional loan that's individually given. So you are now only responsible for your own financial performance, not other owners. So fractional loan is definitely an encouraging development in the TIC financing, but it does come with some downside. For instance, it has a higher interest rate than the conventional loans, and only a limited number of local banks will offer the fractional loan. Another important thing that you should remember is that TIC doesn't offer 30-year fixed loans. So if your big plan is to get a fixed loan for 30 years at this current very low interest rate, then TIC may not be the right fit for you. In the same vein, it is important to get a pre-qualification from the bank, like Sterling Bank, who's offering fractional loans if you are looking for a TIC, even though you're pre-qualified with conventional lenders, because your monthly payment may be different because of the higher interest rate and down payment changes and different terms that fractional loan may have. Another downside of owning a TIC is that you're actually relying on unrecorded agreement. It's called TIC agreement. This agreement is specifying the use of the building, who owns which unit, who uses each unit. In TIC, you're owning only the percentage of the building. Again, you are not owning a specific unit that you reside in. It's only agreed among the owners in this TIC agreement document. However, it's not from the deed, it's not recorded. That's why there's a potential higher risk of owning a TIC versus condo. And you are also facing larger shared obligations like tax bill. For a TIC owner, you will get only one tax bill shared among the all owners. When you own a condo, on the other hand, you will get your own tax bills So the city will issue a tax bill for each unit. However, for the TIC, you're getting one bill together. So usually TIC owners are chipping in every month to save for the property tax. But that can be a cumbersome if you think about it, that you're actually sharing a lot more things than you would have when if you own a condo. With all these disadvantages, one very big advantage makes TIC popular among some buyers. That is obviously the price. Price of TIC are generally 10 to 20% lower than the equivalent of condo. So if you have a limited budget and if you don't mind having a 5 to 7 year loan with a little bit of higher interest, then TIC can be a good option for you. So before you reject it, again, please try to understand better of what risks are and what that TIC exactly means, and then make your final decision. This concludes my seventh habit of understanding TIC, and it also concludes my 7 habits of highly effective San Francisco buyers. Thank you so much for joining. And like always, I'll be happy to hear from you if you have any questions or if you want to know more about any topic. So feel free to contact me at any time. And I hope these videos are helpful for you to look for a property in this competitive San Francisco market. See you next time.